What's up, guys? Welcome back to my YouTube channel where we talk about tech topics, and today we're going to be talking about equity, or specifically equity in a private company, like a startup. Now, if you're not already subscribed to me, go ahead and hit that subscribe button and destroy that like button down below for the YouTube algorithm. Okay, so first, what is equity? Equity is basically a piece of your company. It's like you're becoming a minuscule part owner of your company. And a company will usually give you equity as part of your compensation package in order to align your interests with those of the company. So if the company does well, then your compensation will go up. In order to get equity in a company, you'll need to get grants from the company. And a grant is basically just a contract between you and the company saying that the company will periodically give you equity over a period of time. You will usually get one grant when you first start, which is called your initial grant, and that one usually vests over 4 years. Companies will then give you refresher grants periodically, so usually like after a year, the company will give you your first refresher grant, and that will usually vest over the same period of time, so these just keep on stacking over one another, and the idea behind this is that you are always vested in the company's success. There's also stuff like discretionary grants and promotional grants. So if you're doing really exemplar work, then someone usually at like a director level can choose to give you a discretionary grant before you would normally get your refresher grant. Or if you get promoted, then usually a grant would come along with that too. Okay, so now the question is, how do you vest your equity? And I guess the precursor to that question is, what does it mean to vest equity? And to vest equity basically just means that it becomes yours. So when you first get a grant, for example, let's just say 100,000 over 4 years, that doesn't mean that you get 100,000 right away or even 25,000 your first year right away. So you have to vest it, and usually vesting is time-based. So after a period of time, those shares will become yours. Usually equity will vest every quarter except for the very first 4 quarters, which is a year. And usually the first 4 quarters will only vest at the end of a year. So you get 1 whole year's worth of equity at a time. And this is done in order for companies to sort of retain you longer. So companies actually spend a lot of money trying to recruit talent, and so they don't want someone joining after they've spent a lot of money invested in that and then just leaving maybe halfway through the year. So the 1 year, this is known as a cliff. The 1 year cliff is to incentivize you to stay at least 1 year to get those first 4 quarters of grants. After that, it's pretty simple. Equity will usually vest every quarter, which is every 3 months. Now, everything I've said so far could actually apply to both private and public companies, but here are where it sort of differs between public and private companies. So for example, what I was saying about vesting usually being time-based, in private companies, there may also be a clause where you can't vest your shares until there's a liquidation event, so like an IPO or something, and this is called double trigger. So the first trigger is time, and then the second trigger is also a liquidation event. Now the question becomes, what is a liquidation event? And a liquidation event is basically just an event where the shares can actually be sold for real money. Before we jump into the liquidation events though, one important thing to note is that private company equity usually has an expiration date. So for public companies, you vest your shares, you go ahead and sell them on the stock market, you get your cash, no problem. But for private companies, until there is a liquidation event, your shares, you can't really do anything with them, you kind of just hold on to them. And so there's usually this expiration period of 10 years. And that is the company incentivizing its employees to work towards a liquidation event, because after 10 years, you do lose those shares. Of course, this is an important note, like what the heck, I'm gonna be losing my shares if we don't IPO within 10 years? That's terrible. Now, this is normally just like a wording, like a clause in the contract. I doubt it's hardly ever super enforced, especially for active employees. So if after 10 years you're still there grinding away, then companies might usually reissue you new shares. They won't really let those shares just disappear. Otherwise, you would have a lot of disgruntled employees, but that is important to note as a unique stipulation and difference between private and public companies. Of course, if you've already left the company at that point and then your shares expire, then yeah, the company is not going to be replacing those shares. Now, another question is, how do you value your shares? If you're at a public company, it's super easy. You just open up your favorite stock app and you take a look at your company symbol. That's exactly how much one of your shares is worth. If you're at a private company, it's a bit harder, and basically you have to listen to what the leadership team is telling you and coming out with, and that is your internal value of your share. Now, one way to kind of judge how well your private company is doing is by looking at the valuations that your company is raising money at. Generally, as time progresses, you want to be raising money at a higher valuation than previously done. So for example, if your company is raising money at a valuation of $1 billion, then in 2 years, you do not want to see your company still raising money at $1 billion. That means that investors have felt your company has built zero value in 2 years. Ideally, you want the graph of time and valuation to be up and to the right. And you should be especially worried if your company is raising money at a valuation less than previous valuations. Of course, if your leadership team isn't being very transparent about the value of your shares, then your best bet is to look at the most recent valuation that your company was raising money at, and then the valuation that the company was raising money at when you joined. And then you can take your amount of money that your shares were worth at the time, and then you can use the current valuation to figure out how much your shares are worth today. Okay, but like I mentioned before, shares in a private company are not really worth anything until a liquidation event. For a public company, you go on your favorite stock trading app like Robinhood and you sell your shares when you get them. That's money in your bank, bada bing, bada boom. But for private companies, you can't really do that. That's why you want your company to go through a liquidation event. An IPO is a liquidation event, and an IPO is basically just the company selling shares to raise money in a public market like the US stock market. That's why you want your company to go through a liquidation event where your shares will actually be exchanged for real money. So an IPO is the holy grail of all liquidation events, and it's what all startups should be striving for. And basically that just means that your shares will now be publicly tradable on the markets. There's also a direct listing, which is similar to an IPO. The difference is that in an IPO, the company is trying to raise money by selling off some of its shares. In a direct listing, the company is not. It's just making its shares available to be traded. There is also a direct listing, which is similar to an IPO in that your shares are now able to be publicly traded. The difference between the two is that in an IPO, the company is trying to raise money, so the company is selling shares that it owns. In a direct listing, the company is not. But in both cases, employees will be able to sell their shares. There is one key difference in that in an IPO, there's usually a lockup period where employees cannot sell their shares for a period of time. Usually it's like 6 months, and this is done so that employees don't just flood the market with shares on the very first day when the company is trying to raise money and devalue the stock price. There are also non-public liquidation events. So for example, an acquisition. And an acquisition is just when another company wants to buy yours, and when they want to do this, they have to purchase every single piece of ownership there is out there, so they have to purchase every single share, so including yours. During an acquisition, the company that wants to acquire the other company will offer a dollar amount for every single share there is out there, and your leadership team will either accept or reject the acquisition offer. And if they accept, then your shares will usually vest almost immediately, and you get paid for the number of shares that you have. There are even other ways of selling your shares, such as secondary markets, which are like websites where people are offering to buy equity in private companies. Companies will usually have a clause against this sort of thing because, after all, they want you to have an interest in the company. They don't want a random outsider to have a piece of the company, but it really depends on the company. Some companies don't have a clause against this, and in this case, you would be able to sell your shares on a secondary market to people who are interested in owning a piece of your company. Okay, that's my breakdown of equity in a company. Hopefully you guys found it helpful and useful. If you guys did, make sure to like and subscribe and comment down below with your thoughts on the video. I'd love to hear from you guys. I'll see you guys next time. Thanks.